Ladies and gents, it's your boy Dave P. I got RJ with me, and we have a very special guest today, Mr. Dave Van Horn. And Dave Van Horn is going to explain what his business is, but more importantly, what he talked about. We were on the phone, we were talking about other stuff, and he is licking his chops right now. That real estate market has changed. The real estate market is going down in most areas, in some areas, and this is when Dave is the most profitable in his business. And Dave's going to explain how he makes money in a down market and why he makes money, why this time is the most profitable for his specific business. So with that being said, Dave, what's up, man?
What's going on? Yes, it is we call it summertime. It's coming for us, and
So
we're coming out of wintertime for us.
so let's talk about what has changed in the market. So interest rates have been like historically dirt cheap low for like 13 years or something like that. And that's what you're
Yes.
calling the winter time, but that's been a super hot real estate market for the wholesalers, the fix and flippers, people doing refinances and stuff like that. And what has changed in this past year is the interest rates now are not, they've gone up tremendously. They've gone up really, really fast. And that changes things for the wholesalers and the fix and flippers. It's taking longer to sell properties. They're
Yep.
making less profits and stuff like that. But this is the good time for you. So why don't you start out by just kind of explaining what is your business? What business are you in? How long you've been doing it? And kind of talk about your business.
Well, how long I've been doing real estate is close to 40 years, but how long I've been in this business is since 2007. And we're a private equity fund that invests in mortgages and commercial real estate, but we're primarily in delinquent mortgages. So 75% ish is we call it the NPL side, non-performing loan side of our business. And then we have about 15 to in the high teens, mid teens to high teens in commercial real estate. We have right around 1,000 units, and we're newer to that space. And then we have commercial loans that might make up 5 or 6% of the portfolio. And the commercial loans are short-term business loans, which are really fix and flip loans. We have a company we own 20% of that. We're a facility for them. We give them the money to lend out in 45 states. They originate hard money loans, and then we have first right of refusal to buy those loans, and we use that to regulate capital. So we're raising a lot of capital. Like this year, we're probably on target to raise about 150 million, and we'll buy a lot of those loans. And what that does for us is, if we need to recapitalize, we can put those loans on a line of credit, get the money, and then go make a trade on more mortgages, or we can go do a commercial deal like a multifamily or something like that. So we have a lot of liquidity that way, and we manage our cash drag with the commercial loans, even though it's only 5 to 6% of our portfolio, which is right now it's approaching 700 million, and we have about just under 300 million in private equity. But we keep recycling the private equity, so we're a little bit different than a commercial real estate fund where they'll raise money, go buy a big complex or something, and then they wait. We're kind of turning money a lot with about 75% of our book of business. But what you were referencing is we were talking about wintertime and summertime. When you're in the non-performing loan business, your assets are in direct correlation to real estate values. So when real estate values are up, like you were mentioning, we were in an up market for 5, 10 years there. It was just like going bonkers, right? And for us, that's when prices are high and our margins are thinnest. So now when we see a little bit of disruption, actually the biggest economic indicator for us, unemployment. If unemployment ticks up, that's what really sets off more foreclosures, because there's 4 main reasons people default, which are death, divorce, job loss, and medical. So job loss is a big variable one. And you saw that back in 2008 when unemployment was very high. There wasn't as much equity in the market. There was a lot of junior liens. There was a lot of adjustable rate mortgages. And then we had a field day. So after, like, if we go into a recession, for example, not saying we're dancing in the aisles down the hall here or anything, but recessions actually are the beginning part of where we'll go and have a field day a little bit, because there'll just be more abundance of assets. It's supply and demand equation. The more assets they are, the cheaper they get. And so if real estate values fall, that's actually beneficial to us to get cheaper assets. And we did that after the last crash. We bought a ton of product, got dramatically less expensive. And then high tide raises all ships. So when the real estate values come back up, we're having a field day. So in recent years, we were big sellers, and right now we can actually, we're starting to see the market starting to loosen up a little bit. And then there's going to be some shakeup too, probably more on the commercial side this go around. Definitely in the office and retail, you're seeing, malls are trading at 40 cents on the dollar. I think I just saw something where there was like 700 malls left in the US and expected to be down to 150 malls. So,
man,
we'll be making pickleball courts out of them or whatever,
Yeah, that's a real thing. I'm seeing it happen here. They're taking old tennis facilities and then adding the pickleball thing. But before we move on, you've said you're super smart, Dave. Super smart, right?
I don't know about that.
So I really want to make sure, because some of our audiences don't even understand the note business. In a couple minutes, just give us an example of how you make money in the note business, and just dumb it down so that people like Dave and I can understand. Because sometimes it's just like you because this is your business, and we're in a single family space.
It's true.
And so we're just rattling off ARV and comparable, blah blah blah. Right. But in the note business,
so what is a
different.
note, right? And just, when I'm referring to notes, I'm really referring to notes and mortgages, but there's all types of notes. A note is really a promise to pay. And I like to tell people that we're all in the note business. We just might not realize we're participating in it, right? So there's student loans, there's student loan debt, credit card debt, auto debt, medical debt, and then of course, mortgage debt. So there's all types of debt. There's trillions and trillions of dollars worth of debt. In fact, the room you're sitting in, if you were to look around, everything there has been financed from the land up. Everything has been financed. Your clothes on your back, the car in the driveway, everything's been financed. We're just not realizing it. We're not paying attention to it. We write payments to stuff. We don't think about it, but we're all in the note business. And I'm not saying people have to do what I do. They can invest in what they know. Like I've talked with like dentists, or even my heating and air conditioning guy. At one point, I was like, well, did you ever think of financing the heaters and the air conditioning units? And he's like, oh, there's a company that does that. I go, did you ever think of owning it? And he's like, oh, you can do that? And I'm like, yeah. And, even if he gets a deposit, might pay for the unit, and then he's financing the labor. And then if they don't pay him, he can put a mechanics lien on the property, right? Like it's a secure deal. Plus, he'll get more service contracts, increase the value of his business. So no one says you got to do mortgages like Dave, but you can do the finance business in an infinite number of ways. You could finance the grasshopper for the landscaper. It just goes on and on and on. It's really how far do you want to go with that? But I'm in the mortgage space when I refer to notes and mortgages. I like collateral. So what was sexy for me was, if I can invest in something, if I can buy something at a discount with a high yield with collateral, that appealed to me at the time. And then, the rest is kind of history. It took off from there.
So you don't necessarily, you're not managing any tenant, right?
Not normally, no.
Not normally.
It would be extremely rare. It would be a case where, I'm not saying we never had a squatter or something. We typically sell a couple hundred REO properties every year. So I don't know if anybody goes to the sheriff's sale. The attorney for the bank would be my attorney. And we liquidate probably, a couple hundred houses a year in various markets. But it's mostly where the population is. Like we don't get a lot of loans in Wyoming or Vermont. But I bet our top 5 states are California, Texas, Florida, New York, Pennsylvania, that kind of stuff, where it's more population. Wherever the population centers, we get a lot of Chicagoland loans, all that kind of stuff. So,
so you're investing in somebody's note and mortgage, right?
Yeah,
and
they're all bank originated. All
bank originated, and then what you do with it is, like let's say Dave had a house and it was going sideways, Dave P, and then there's a solid note right in place. So you then buy that note, and then what would you do to that note? Like, would you find a new renter?
We
would you
massage
flip
it? Like we go like this. No, in all honesty, there's probably about a half a dozen exits, and really it comes down to 2 things. A couple things. One is you're either exiting through the borrower or the property. And if we can exit through the borrower, we prefer that. So we're really trying to keep people in their homes first and foremost, but sometimes that doesn't always, isn't always the case because part of it is an affordability play. But you can help people move on too, right? So you can do some things that are different than a bank could do because a bank's in it for the full nut. If we're buying it at a discount, we can kind of share some of that discount with the borrower. Almost like, the We Buy Houses folks, right? They're sitting in someone's living room, figuring out a deal out of what's there, right? We're kind of I don't want to say a step ahead of that in a way, but we have competition too, but we're doing it more on the bank side before it gets to that. We're kind of ahead of that in the pecking order, so to speak.
Got it. So then
and real quick, I had a question. So did you say your fund is $700 million? That's what I heard. I went blank after that. 700 million, is that the size of your fund?
We have multiple funds, but yeah, that's what we have in AUM.
Yeah, assets under management. That's what that means, everybody, if you're not familiar. AUM. And your main space is like the non-performing loan. That's what NPL is, right? Non-performing loan space. So when with a fund in the money that you manage of that magnitude, you're not just buying one defaulted mortgage here. So you're probably going to maybe you can touch on that. Like you go to an institution, like a big bank who's got all of this paper, all of these notes, and the people stopped paying. So the bank just wants money back. So they'll sell you a big block of loans. Is that kind of how it works?
Yeah, well, for us, we have a JV partner on the West Coast, and it's not unheard of for us to buy several $100 million per year because we usually have to get up to, we'll do multiple trades and aggregate that up to at least 200 million before we can do a securitization, which is really a fancy word for saying you're refinancing a pool of mortgages. So we aggregate trades, almost like dollar cost averaging, right? Where we go out and we make multiple trades, aggregate them up to a critical mass. Once we get over 200 million, we can refinance that pool. Now, we also utilize leverage. So, our partners on the West Coast, they actually have a trade desk in New York. So that gets us access to product. We have some institutional capital when we go to buy, some larger institutionals. So we put up a percentage of the capital, which is the private equity. And that's what we're known for, raising a lot of private equity quickly. And then we marry that with the institutional money. Then we go make trades, right? And then you go do it all over again. Usually it's about a 33 to 36 month cycle. So we'll typically go out and start a joint venture with our JV partners. We'll raise some private equity, marry it with the institutional capital, go out and make some large trades, aggregate those trades up, do a securitization, which is really a refinance. And then you'll start to wind down that pool, those pools. And then what'll happen is you'll go do that again. You'll set up another structure and go do the same and just repeat the process. We're in, I don't know what phase we're in now. We've done multiple, of these transactions where they're kind of segregated a little bit, just like, that's one of the reasons we have more than one fund is sometimes you're segregating liability and risk, just like a builder would. A builder's going to have a different entity for every cul-de-sac he builds, right?
And so how many so basically you raise private money. That's what private equity is when you say that, right? So you find individuals and they invest in your fund and their money is collateralized by notes. Is that correct?
Correct. The minute they come into one of our funds, they're instantly diversified. We have, hundreds, if not thousands of mortgages all throughout the United States. And so you're kind of have this instant diversification when someone comes in the fund. And it's much different than if they were to go buy one note or something, because the biggest risk is a lack of capital or not enough capital deployed is really your biggest risk. When you're buying a onesie twosie note, you're taking on the liability instead of the fund, right? So you have more risk, more compliance risk, things like that. So in some cases, investors prefer, we're a very passive investment, right? And we've been around, this is our 16th year. So we have a long track record. we're very passive. We're true mailbox money. Whereas a lot of times real estate is anything but passive. It's passive to the IRS, maybe.
Yeah.
Yeah.
How many people do you have on your total team? I'm just curious.
32 right now. So we're not a
32.
super big shop. Yeah.
Yeah, no, that's amazing. So you raise the private money, you have these funds, then you have your connections to buy these giant pools of mortgages. So one pool that you buy may have hundreds and hundreds of mortgages. Is that correct?
Yes, but I do want to point out that some of our JV partners have decent sized staffs too, right? So our West Coast partners probably in the 50 range of people, and then that company we own a piece of, they have like I think they're up to 25, 30 people too. So there's some of these JV partners have, if we combined everything and we didn't have that, we might be at 150 people, if that makes sense. Yeah.
And so you guys will buy this giant block of loans, and then you said you're either going to exit this thing from the homeowner or for the person living there or from the property. And your first choice then is to work something out with the person living there and keep them in their home. Is that correct?
Yes, it's usually always not even that it's the most profitable way, but it's kind of part of it is what is the borrower intent. So we don't always drive that process, right? Because if they want to reinstate their loan, they will, right? Or if they want to make payments, or they got a job again, or so it's not always up to us to say, oh, well, I just bought your loan, so I'm going to make you get out or something. It doesn't really work that way. It really comes down to borrower intent and affordability, really.
And do you, that makes total sense. And that's really good of what you're doing. I mean, you guys want to work it out with the person living there. Maybe the bank who sold you this defaulted mortgage, maybe they don't want, they just want to boot the person out. Who knows what their program is? It's probably better for the homeowner that you guys come in and try to work something out with them. Do you guys ever sell defaulted notes to smaller investors then? So you buy this giant package of notes. Some of these you're working with the homeowners and whatnot. Do you ever just break it up and like sell chunks of mortgages or even onesie twosie to one-off investors?
We did that for years. We used to teach the business. We used to sell one-off notes and smaller, but as we grew and the compliance changed too. So it got, the regulatory environment got so strict. And what really changed after Dodd-Frank was you became responsible for the data transfer when you sold the loans, right? So, what part of that means is all of a sudden we were responsible for who we sold to. Prior to Dodd-Frank, it was a little bit of the Wild West, whereas you could kind of sell loans to anybody. It wasn't as regulated. But today, like if you sold loans to a party that mishandled those loans, there could be recourse against us, right? So that starts to change the game, right? So in some ways, you're forced to, it's much more advantageous for us to sell in bulk to, compliant parties, really. That's really what it is. Now, that's one of the reasons, like, if you said to me, if you did the note business today, what would you do? I'd probably be more in the commercial note side, like the fix and flip loans, those kinds of things, because they're not as regulated as much as the Harry homeowner residential loan, right? So they're the ones that are regulated the most. Owner occupant loans are the most regulated, right? So
the
like
homeowners are the most protected. Yeah.
Yeah. So if I do a commercial loan on a fix and flip or a you know what I mean? It's it's just like, I'm sure you see it with eviction, right? It's much different evicting someone from a storage unit than it is evicting them from their house at Christmas time. I'm making stuff up, but you get the point.
Yes. So what you're saying is like you guys dabble more so in the commercial space for that reason, because the residential space, or when you're dealing with homeowners, it's much more highly regulated, I assume.
Well, we do work with the residential loans, but we have a compliant JV partner who's fully licensed everywhere. We have servicers. Everything's buttoned up on the compliance side. Whereas if the individual tried to do that, it would be a big undertaking and a lot of cost and expense, and
Right.
it just takes a lot of scale to get enough efficiency. That's the truth of the matter, really.
So the reason, I guess we could answer, the reason your business actually does better when the market goes down is because essentially there's more people defaulting on their mortgages, which means more stuff for you to buy and either work it out
Yes.
with the homeowner or resell or more assets to control.
Yeah, I mean, if if you were you're an investor and you were looking for a place to place capital, if we're heading towards recessionary times, we're probably one of the more ideal candidates. Whereas in an up market, most people don't pay as much attention to us, right? They're busy doing all the other stuff with real estate, whether it's multifamily or whatever they're doing, right? And that's myself included, because I'm an investor on a personal side, and I do a lot of these things as well, right? I have a whole strategy what I do personally, then we have a whole strategy what the company does. The company obviously is more conservative, it's stricter. I mean, we have a full-time economist on staff, we have a CIO, we have an investment committee. So it's not a case where like Dave raises money and he can go do whatever he wants. Sometimes I wish it was that way, but it's not, right? So it's very strategic. So depending on what the market's doing, so we'll get like a investment thesis for the year, and then we get investment thesis for the quarter, and then it's we have different investment verticals, and then there's different allocations to those verticals based on what the market's doing. So a lot of our strategy today is more on the short-term side. Some of it's defensive, depending on what the investment vehicles are. Like multifamily, for example, we only do a very strategic couple of areas that we work in. One is in affordable housing. It's because it's a different ball game. You're in a different stadium than the traditional multifamily. And then some of the other multifamily we're doing is it's more of a short-term development plays where we're in and out. And when you're in and out like that, it's less market risk, less interest rate risk, right? So there's different things we can do. Just like in the NPL world, we can invest in. I'll give you an example. You can invest in mortgage servicing rights, and that's they go up in value when inflation goes up. So there's different hedges we can do in our business to basically, I don't want to say make money in all markets, but in a way, that's what you're doing. You're hedging, various market conditions.
So what you're talking about is like when the market changes, you guys have the ability to pivot your business to maximize what's going on in the marketplace. So I wanted to ask, where do you see the current market? So today's May 19th, 2023. Interest rates for homeowners are what, 6.5% ish?
Yep.
So they have gone up from 3.5 to 6.5 just over the last year. And I guess, what do you see? Do you see rates continuing to go up, or maybe you can kind of give us some insight on what you are kind of forecasting?
Well, our team's in the mode of, whether or not you'll see one more quarter or point or not, that's the recent variable. But I think over the next 2 years, we're expecting the rates to come down about half of what they've gone up over the next 2 years. I don't think you're going to see a decline this year. We're not expecting that. So now that means if nothing crazy happens, like China invades Taiwan or something, we can't predict that kind of thing. So it is a little bit arbitrary that way, but we've been through cycles like this before. I know when I bought my first property when I started in real estate in 1987, rates were 14. And at one point I had 40 places of my own, and I had a place I bought in 2006, the rates were 8. So think about that. From 1987 to 2006, rates were between 14 and 8. You could consider that a high interest rate environment for that period of time. That's a long period of time. And, I was a realtor, I was a fix and flipper, and I was a we buy houses guy and all that stuff during that time period, right? And we made money. We just did it in different ways, right? Our strategies shifted, how we did business shifted. I remember my kids say that to me. They're like, "Can you believe the rates have gone up?" I'm like, "These aren't high, guys. Like, they're not double digit or anything." It was funny. I was telling my sons are in their 30s, and I was telling my one son, I go, remember the house you lived in when you were a kid over in this
Yeah.
town over here? And I go, I paid 11% and 6 points to move in that house. I had to buy out a partner. We had renovated it.
Mhm.
The house burnt down. We rebuilt it and bought out my partner, and rates were 11% and 6 points to buy out my partner. Right. So even my kids are like, you paid that? And I go, yeah, but the funny thing is we still made money. So I said, and there's ways to do that, right? And you'll see that now. I think the big opportunity we'll probably see is more on the commercial real estate side, especially in multifamily, for example. There was a lot of bridge financing in the last 5 years, and you're going to see a lot of that resetting. The cap rates are up. They can't get the prices they thought they were going to get if they sold. If they refinance, the terms are terrible. If they keep it and they reset, it's just like lose, 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 lose in a lot of cases for some folks. So there's definitely going to be a little fallout from that. And I could see where we could come in and assist.
Also, a lot of people were buying and speculating on commercial assets and buying at very low cap rates over the years. So they were already kind of paying too much for stuff. And what you're saying is if they got like a bridge loan, which is also kind of like a shorter term type of loan, what Dave is saying is, I mean, if you owe too much on it and you can't refinance because the interest rates are higher now and the deal no longer makes sense, no one will give you the money for it to refi, and you can't sell it because you paid more than you can sell it for, and your negative cash flow because you can't service and pay the existing loan. That's the lose, lose, lose Dave is talking about. Is that about right?
Yeah, you could be in a pretty precarious situation where nobody wants to go to work every day and not make any money or lose money every day. That gets depressing pretty quickly. Who did I just hear? I think it was Warren Buffett was saying about commercial real estate. He was talking at the shareholders meeting. And it was something along the lines of, he was saying, how do you value commercial real estate? And it's really what a bank's willing to lend on a non-recourse loan dictates what that value is, right? And it's kind of interesting way to look at it, right? So it's right now, obviously, rents are, I don't know that rents are declining everywhere. Like we have some multifamily and commercial stuff in Georgia and Austin, and rents are in some of the high growth areas. It's not like they're super declining or anything, but they're kind of leveling off, or they're not increasing as much as they were. But it's very geographic. You're going to see areas where they are impacted. I know the west part of the country was faring differently than the eastern part of the country. So yeah, you're going to see, and some of that is, some areas swing more than others. When they go up or they go down, they swing more. But it's going to get interesting, and that's the beauty of when things change, right? Are you prepared? Do you have dry powder, and are you able to go pounce on something? And for us, we're fortunate that we have places to park money while we wait, and we can be patient, and then we can move.
Do you invest in short-term treasuries?
Personally, no.
Oh, no. I know a lot of, we talked to another fund manager, and that's where they were parking money, like while they kind of waited with their dry powder. And we just heard that from somebody else. So I was just curious, like.
No, most of ours is in fix and flip loans. We also buy some bank originated. We were buying bridge loans that were usually 1 to 2 year in length, and they'd be in the $1 to $10 million range. Again, they were bank originated, like construction type loans. We don't buy as much of that today. Mostly it's on the fix and flip side. We do like that product because rates are up, right? The rates are in the 11s and 12s and points. And the other thing is it's an advantage for us because we get paid on our facility, and then we can also make it a little big when we buy the loans, and then we own a piece of the company and how well they do, right? So we have an advantage 3 different ways there for when we're dealing with those types of loans. But the beauty of that is, like, I'll give you an example. About a year or so ago, we would lose a little bit of money. Like, we pay our investors a pretty high yield in our funds, and we would have a negative carry. So we might pay a percent or two of a loss because we're paying our investors, and our money's in a note that's not paying quite as much. But now the hard money loans are up, we're actually making money right now on those, right? Where we don't, it's not a big revenue center for us. Like I remember me saying it was only like 5-6% of our portfolio. It's more of a regulator, but if I'm paying investors 10 or 12%, well, that's a lot of money that's going out the door while money's parked, right? Where if I can reduce that to 1% or 2%, that's a win for us, where we have a lot less negative carry while we're waiting to go, accumulate enough capital to go make a large trade. And then there's economy of scale while making large trades, right? So it's, how do you limit that? And that's one of the beauties of that model that we're able to do. And we can actually deploy quite a bit of that money. And then we have a lot of liquidity with that money, because we can sell it through our trade desk on the secondary market. We can put it on our line of credit and recapitalize within days. We can, we can even lump them into a securitization. So if the securitization's going off, you can actually put those kind of loans into that as well. So you have a lot of liquidity options with that type of an asset. And then they're all real estate backed, right? The LTVs are actually better than the underwriting stricter. The terms are more expensive. I'm not saying we like that, but we kind of do like that. So.
And people are willing to pay the higher rates. That's what you're talking about, like fix and flippers and stuff like that. I know we're still paying double-digit interest, and that's our true private money. But like hard money companies out there, that's what Dave's talking about here, is people are willing to borrow it. I mean, there's always a play. There's always a way to make money. There's always a borrower, really, in any market as well. RJ, before we turn it over to kind of what Dave would suggest to somebody who's just getting started, what questions do you have?
I don't. Actually, my where I'm trying to wrap my head around is your question. Somebody new, somebody's in single family space, they want to make the switch, into note investing. How do they even do that? That would be my question, because it sounds like I wouldn't say easier. There's like different steps involved, but we're in the world of dealing with tenants and then eviction and all that stuff. You sometimes run into that, but the majority of what you're doing is buying some note that's distressed, and there's a margin there, right, where you make the money, and then you either just keep it and cash flow it, or you can group it again and then kind of resell it. Right.
I mean, we buy performing loans too, and we buy RPLs, which are reperforming loans. So we buy all three. But you're right, we buy mostly NPLs, which are non-performing. But if I was starting in real estate, or I wanted to get into the note business, it's like anything else. I would be like, well, what kind of investor are you? And what is your experience level and all those types of things. And even if you get into the note business, you don't necessarily have to, take a lot of risk or risk a lot of your capital. You could shadow someone else's deal till you figure out what you're doing, that kind of thing. I know when I started in the note business, it was me as a private lender is one of the ways I started. I was a private lender for other contractors. There was a time when I was for 22 years, I was a contractor, right? So, and I would lend back and forth to my friends, and they would lend to me, my contractor buddies and fix and flip guys, right? So, and gals. And so we would lend each other money, that kind of stuff. And that's one of the ways in the note business. I even do some stuff with my family. I'm doing a mortgage for my son right now. He's pulling money out of one of his properties. He's funneling money in to expand his business. He's investing some of the money actually in my company. And he's getting free use of like $100-something grand to go do something. So it's like one of the neat things me and my family were doing for a while. I have like cousins and brother-in-laws and stuff like that. And we had rental properties. We all, probably much like you guys do. And one of the things we did was we're like, hey, we're tired of paying Wells Fargo. Why don't we pay each other? And what we started doing was we would create these like interest-only loans, and we would lend each other money from our IRA accounts and from our lines of credit. And then we, instead of paying Wells Fargo, we would jack the interest only loans, and then we put insurance on it. We all had insurance on each other, like enough insurance that we weren't concerned about each other. And then we would just pay each other, and we would funnel like high rates of interest only. It's kind of what I'm doing with my son right now. I'm charging him an interest only loan. It's a 5-year note. His payment's lower because it's interest only. He gets a bigger write-off, and he needs write-offs because his business is doing good. I'm funneling a larger percentage of money into my into a trust I have. So it's like Yeah, I mean, we can pay each other. Like, why are we giving all this interest to the banks? Like, I sit here and shake my head, going, "We're crazy." Like, we could be giving all the interest to each other, and it'd be safe and secure and LTVs, and we all know the properties. We're all from the air. You know, we all do the same thing, right? Like,
Yeah.
so it's just a different way of looking at things. But you can do notes a multitude of ways, but and then you can also invest depending how much money you have. Like if you're a accredited investor, you have more opportunities. There's all kinds of note funds and things like that. If you're not accredited, there's still some opportunities. You'll see some of the crowdfunding platforms, and you can invest in notes with. I've seen it as low as $100. You can invest in. So it's really, it's just a different world, right? And maybe people aren't as familiar with it as they are with general real estate.
If you want to make a lot of money, it doesn't hurt to be in the money business, as Dave Van Horn is. You're in the money business more so than you're in the real estate business. Real estate's just the collateral, right? I mean, you're
yeah. I mean, I'm a really simple investor. I mean, my strategy is funny. Somebody's asking me that. They're like, "What's your strategy in this market?" I'm like, "It's the same. It doesn't change." I mean, it changes a little bit, but it doesn't. I do short-term, mid-term, long-term, tax advantage, non-tax advantage, and I invest in what I know, which is lending related, real estate related, and I do a little bit of it on the insurance side. And these are all areas I had licenses in and was doing it a long time. So if you said to me, "Hey, I'm investing in, I don't know, a nightclub or something," I might go, "Yeah, I'll come over and have a beer with you, but I'm not investing," because it's outside my box, right? And once in a while, I'll do a little bit on the alternative side, but it's usually something else that depreciates or something.
So Dave, where do people find you if they want to learn more about you, your funds, and what's the best way to get in contact with you?
Probably the easiest is we have our website. It's PPR Capital Management, MGMT.com. So PPR Capital, MGMT.com. We have a full investor relations team. You can go there and ask questions, whatever. And I'm also on Bigger Pockets a lot. I wrote a book on Bigger Pockets, real estate note investing. If people want to learn more about it. But we also answer questions in the forums on Bigger Pockets about notes and all kinds of everything real estate. And then we have a group on LinkedIn too, a distressed mortgages group on LinkedIn. If people, have a question about note investing, or we're happy to answer those people.
We will link your website below, Dave Van Horn. We appreciate you hopping on. And everybody, we appreciate you watching. If you want to know anything about the note business, obviously, if you've been watching this whole time, Dave knows his stuff. And RJ and I appreciate you, Dave, and appreciate all of our viewers. And we will see you on the next